Well, good afternoon and welcome to AGH Wealth Management's 2024 Annual Market and Economic Outlook. We're pleased you joined us today and look forward to giving you our perspective of what to look for as we continue to make our way through the calendar year. Due to some internal personnel changes, we were a little delayed in getting this outlook to you, so we appreciate those of you who've been asking and your patience on us getting this done. But with the leap year added, we were able to still get it in February, so we count that as a blessing. But we appreciate you guys being here, and I hope this is informative and helpful as we look at our economy and the markets. My name's Brian Gensch. I'm Senior Vice President at AGH Wealth. I oversee our private wealth investment strategies and as well as our comprehensive wealth planning service. My usual counterpart, our president of the group, Brad Bechtel, was not able to join us today on the call. However, we both are available for follow-up discussion using the contact information that you see on the slide. So please don't hesitate to reach out to us for any questions or comments about this presentation. So twice a year, we give an annual and then mid-year outlook for the markets and the economy based on our broker-dealer LPL Financial's published outlooks. Because enough information has changed slightly since the publishing of LPL's outlook, we're not going to go through their shared presentation and slides today. We will still have their bound report, both in paper form and electronic form, for anyone who would like a copy. So again, please reach out to us and we're happy to get you a personal copy. But instead, today we'll be running through a similar format, but updated with charts that are more recent and more timely to enhance the conversation and provide more up-to-date thoughts on what our economy and markets look like today. We'll also provide at the end of this presentation the most recent positioning views for the stock and bond and alternative markets that LPL Research puts out monthly. So we will show their February position biases at the end of this presentation. Our agenda today is going to be to go over the economic landscape, how the Fed is positioned with their monetary policy, how stocks and bonds have responded, and what we can expect going forward with economic growth, Fed policies, stock and bond performance, and then a bit on the current political environment. So it really will be a full agenda today. And again, we appreciate your time and your consideration of our outlook. So under the economic development for the year, you were focused on four main areas of development: gross domestic product, or GDP, which measures the overall either expansion or contraction of our economy; inflation and the direction and pace of that inflation; the job market and the continued environment we see there; and then finally the health of our consumer as a major driver of that economic growth. So our economy's GDP is expected to slow down to a more moderate pace of growth over the course of this next year, as interest rate costs have stayed high and curbed consumer and business spending. We expect to see a cooling off of the massive growth that we experienced post-pandemic. So our GDP is made up of multiple components, which is important to understand and how it affects the reading each quarter. The most important aspect of GDP, or our economic growth, the most fundamental driver of that, is our ability as consumers to consume, to spend money. This accounts for roughly 68 to 70% of the overall reading each quarter. The majority of the rest of the reading is split between business spending and then government spending. And then there's net imports and exports that round off our number. Looking at the dotted line on the graph, one obvious note is that in 2022, we had two negative GDP readings, so negative quarterly readings of our economy contracting. So that constitutes a technical recession. However, the one characteristic that did not exist during those two negative readings is what we usually see in what we would define as an actual recession, which is negative consumption. So the AGH orange of personal consumption was not a component of those negative readings. And looking most recently, personal consumption has continued to stay strong over the last few quarters. But as interest costs and overall cost of living has stayed elevated and will continue to be above average for 2024, we do believe that personal consumption will be the piece of the pie that slows down, causing us to maintain a more mundane economic growth period this year. So with that in mind, LPL Research is predicting a GDP year-over-year increase in the US of roughly 1.4%, with slightly lower growth expectations for the developed markets. Emerging markets are predicted to continue to expand at a faster pace. They typically always do, but they also experience higher inflationary pressures. And so I actually would presume that LPL might readjust that GDP expectation after today's inflation reading to maybe even slightly slower than the 1.4%. But reducing and getting back down to a more moderate growth in our economy is the expectation for the rest of the year. So on inflation, we've continued to see a cooling off effect of inflation in the US. From our peak in the middle of 2022, we've come much further down to more sustainable levels, although it's still higher than what the Fed's target rate is of 2%. And this has by far been one of the biggest recent movers of the equity markets, as we received more elevated readings of inflation in our CPI number and PPI number, which is consumer and business inflation. And we had that a few weeks ago, and we saw some negative reaction to that in the market. It's not uncommon, and we do continue to expect to see labor markets slowly loosen, wage inflation to continue to drop, and services inflation to continue its downward trend this year. We got numbers this morning actually from a different inflation reading, which is actually the reading that the Fed prefers. And it showed and can kind of confirm that consumer spending is slowing down slightly, and also that services inflation is continuing to be the pressure that we see on inflation today. So let's talk about services and goods. So when we look at CPI or our index of inflation, the two main components include consumer goods and consumer services. So we're looking at core CPI in this graph. Core CPI takes all of CPI, which we call headline CPI, and it takes out food and energy prices. Not because they're not important. Obviously, food and energy are very important to us as we consume, but because they are much more volatile and they can mislead where the long-term trajectory of inflation is going. So we like to look at core inflation when we're looking at future inflation and what we can expect the trend to look like. So goods historically has been as you can see, it's the black line on the screen. Goods historically has been a slower inflation than services. With goods, think like new and used vehicle sales, apparel, and other commodities that we buy. If you remember back in pandemic, which I know we're getting further and further away from having to even mention it, but if you remember back then, the supply chain globally was extremely disrupted, and it sent a shock to prices of consumer goods. And it was a huge reason for the increase of overall inflation rating. And you can see that, how it happened so volatilely in this graph with the black line. Services, so think shelter, transportation, medical services, also like your insurance policies, like your home and auto insurance, things like that. That has historically been a higher component of our inflation. Now, it also had a sharp increase post-pandemic and has taken a longer time to come down. And this is really where the Fed has been the most concerned as they think about their Fed policy and rates. Particularly, the Fed is focused on shelter cost as it contemplates its policy changes. Shelter cost is a big component of a lot of people's spending, especially as you get to the lower wage earner or the middle and lower class, which the Fed is very focused on. And this has been a bit more stubborn, and unlike goods inflation, hasn't come back down to that pre-pandemic high yet. So it's showing a fairly consistent trend still, and we expect that trend to continue throughout the rest of the year and to really be the component that that really gives the Fed their signal on when that first rate cut would happen. And if we look at the long-term inflation projections, the market is pricing in much lower long-term inflation than back in early and mid 2022. And this continues to be above the Fed's desired target of 2%, but these numbers don't necessarily need to fall substantially for the Fed to begin loosening their policy right now. If you think about it, the Fed has a rate right now that is extremely what we call tight. So it's very high, very costly. They necessarily don't have to hit that 2% target now or in these 5-year inflationary readings to lower that high rate. What they'll do is they'll want to lower it as they continue to see inflation slow down, but it doesn't have to get to that 2% target to get that first rate cut. And that's kind of where the market has been playing games with the Fed, and the Fed games with the market on their rhetoric and when is that going to happen. One of the signs of consumer health and business health really is the health of the labor market, and we continue to see elevated job openings. However, the overall direction is still moving toward a less tight market. One of the most important reasons that a tight labor market loosening is good is that it helps stem wage inflation, which can be a really heavy cost to a business. Wage inflation is important for consumers so they can keep up with the rising cost of living. And wage inflation has historically been slightly higher than cost of living inflation. However, when we look at wage inflation, anything over about 4% is considered high. And when the job market was tightened in 2021, we saw an impressive increase in then what we call the quit rate. And this actually was one of the things that put a lot of pressure on wages back in 2021 and 2022. Historically, when you measure wage inflation to people who stay with their employer and then measure wage inflation for those who switch employers, it's kind of clear that there's always a slightly higher inflation associated with switching jobs versus staying. This is kind of indicative of, finding another opportunity and an employer going out and buying that employee from the other company. So you have to give a little bit more than the standard increase that they would get by staying at a job. So switching jobs, so switchers are always a little higher in wage inflation than stayers. However, in 2022, because of how tight the labor market got and how much inflation was eating at consumer finances, companies were forced to pay more to their employees. And so when you see that quit rate from the last slide spike, what that did was put a delay on, but also spiked that wage inflation because people were quitting to go to new jobs because people were buying those employees at a much higher rate than usual. And so in this environment, the job switchers had an above average pay increase versus the stayers, and that contributed to that wage inflation. However, we have seen that difference consolidate over the last few years. So you can see the delta between the two has slowed down, has minimized. And so as quit rates continue to come down, we expect overall wages to continue to slow down their pace of inflation, which will in turn produce a more appropriate level of overall inflation for the Fed to feel comfortable adjusting that rate or their monetary policy. So when we look at the quit rate, we're interested in seeing that trajectory continue to go down because we want to see stability in the job market and stability in wage inflation. So to just run full circle with our economy, because consumer spending is such an important of that GDP number that we talked about, it'd be hard not to talk about the consumer and the state of our consumer credit. So I hear a lot of worry from investors when I meet with clients about the state of the credit card balances and auto loan balances in our country. And I agree that we've seen an increase in balances for consumer debt. I think the most important lens to look at our debt situation, though, is to do it in comparison to the ability to make money, or our disposable income. So, I just got done discussing how by and large, consumers have really experienced a high wage increase in their household finances over the last 3 or 4 years. So as important as the balance sheet risk is of how much debt do they have on their books, I think the more important lens to look through is how much is that debt costing them as it relates to how much they're making, that disposable income that they get to spend every year or every month. Rates have gone up. Credit card and auto loans are much more expensive these days than they have been for the last many decades. So for that cost of debt is overtaking our household finances, that is a concern. However, when you look at the data, what you see is that household income has more than satisfied the household debt that has been accumulated. In fact, we're still under pre-pandemic lows. So maybe the more concerning piece of consumer debt is delinquencies, which maybe would be a sign of the future state of our consumer spending and credit issues. And that's somewhere where we are seeing a bit of a breakdown. So both auto and credit card delinquencies has gone above our pre-pandemic levels, and this is concerning. And many consumers received higher wages and began spending it immediately. Many consumers received stimulus money from the government between 2020 and 2021. They really got used to a higher spending lifestyle. Save for their wages going up, consumers have potentially psychologically had a change in that what's enough number. And that can be a bit scary as we see them begin to go delinquent on their credit. And the only one that really is waiting to be seen is student loans, that orange number, or that orange line on the right side. Student loan debt is really only in the last 90 to 120 days really begin to reaccumulate interest and be forced to have payments made. So there's a bit of concern there, and we see that cause of concern inside the economic landscape and how that could create a lower spending consumer in the future, which is one of the reasons we do again go back to seeing our GDP number, our economic growth slowing down, still expanding as an economy, but at a slower pace. So I guess the good news is the economy is much more important. And so we had a lot of slides on the economy. We'll spend a fraction of the time talking about the Fed, because if you've been in any of our past ones, we've spent many a day, an hour talking about the Fed and what they're doing. So currently the Fed is every plan to begin lowering their federal funds rate this year. This was really all but promised to us late last year, and the market had a bit of an expectation reset it's gone through since then. The Fed is currently sitting at an extremely high rate given our current inflationary environment and consumer finances. Lowering this rate is a really important function to drive us closer to more realistic interest rates, both on the short-term part of the curve and the long-term part of the Treasury curve, which we'll talk about when we talk about bonds. They are also continuing to lower their balance sheet each month, which is a positive and creates a better ammunition for us if we do go into a recession, and if we get hit with more of a real collapsing or contracting economy. But I want to talk a bit more about that Treasury yield curve, because that's an important piece of the bond market, and we'll talk about that when we get to the bonds. And I didn't do this in this graph, but if you would slap over this chart CPI or inflation, what you actually see is that the Fed really never starts their rate cutting cycle until after that inflation reading has gone underneath where their Fed fund rate sits. So we knew, in 2022, as they were raising rates, we knew that it was going to be hard for them to have a rate cut anytime soon because inflation was so high. But as inflation came down, we became more optimistic that they would at least stop their rate hiking cycle. And whether they stopped it too late or too soon, I think, in maybe 5 years, we'll be able to really digest that and know. But right now, with the Fed funds rate being at 5.25 to 5.5%, and the inflation readings being well underneath that, we're poised to have that rate cut start, and that'll be important for our economy, for our consumers, for our businesses, and for our markets. So let's talk about stocks. The stock market, saw positive returns last year. However, the breadth of those returns. So in other words, how many stocks participated in that growth? It was not shared equally across the market. Moving through 2024, we do believe that the focus will turn away from the Fed as the key driver and really be more concerned about companies' ability to earn money for the year. You can see here the dispersion of returns in the US market was heavily weighted into one stock style, large cap growth stocks. So if you look at the 2023 matrix, all the way to the top right, large growth companies last year performed in the 40% return range, while you had value stocks or stocks that pay dividends and that don't have as much swing in their prices went up a lot less. Now, if you flip back to our looking at this in 2022, you'll see the exact opposite, where value did better because it didn't swing as low. But by and large, a big piece of that market return we got last year was because of that large growth space. And this was really heavily driven by this newly named Magnificent Seven. So companies that have a leading edge in the generative AI technology that's pushing certain companies forward and creating longer term revenue pockets for major companies. So while other areas of the market also did well, it was clear that the takeaway from last year was investors are hyped up on the future of AI and what it will bring to companies' ability to generate cash flow. It's good to be reminded sometimes that the returns that we see in our U.S. indexes, like for instance in this case the S&P 500, it's actually a byproduct of really three main components. One, dividends received. So any dividend you get for the year is counted as part of your return. The second is year-over-year change in earnings. So how much more money did the stock market as a whole make this year versus how much they made last year? So that year-over-year increase or decrease in earnings. And the third component, though, and this is the one that really is pretty volatile, is what are we as investors willing to pay for those earnings? Now, we describe this in a couple ways. Some people call it our multiples. You might have heard it as commonly known as the PE ratio, the price to earnings ratio. But what is the ratio that we're willing to buy? How many times that earnings are we willing to buy the market at? And looking at the major index in the US here, we see that whatever the final year's return was, which I notate by that little X, it was actually a collection of the three different components. And there's some standout years I kind of want to note. And if you look at 2018, we actually put out one of the best earnings year-over-year increases in a really long time, around 20%. And I know this graph kind of doesn't do it justice because we see 2021 and the massive earnings increase from our massive decrease in 2020. That was a very pandemic-induced year-over-year changes. So if you strip that out and you really just look at 2018, 2018 was a fantastic year in earnings growth, around 20%. But if you remember, and many won't, but I definitely remember back then in the fourth quarter of 2018, Jerome Powell was just getting situated as his new role as chair, increasing interest rates, kind of puffing his chest up against then administration with Trump, who was wanting him to lower rates, and he was very independent. And so there's kind of this battle, and for other reasons as well, he was increasing rates. Because of that, the S&P ended the year with a total return of -4%. The earnings at the beginning of the year, investors were willing to pay for those earnings at about 18 to 19 times earnings. by the end of the year, because of all the scare of are we raising rates too high, inflation is getting out of hand, investors were actually only willing to pay roughly 14.5 times earnings. So even though we had a great year and the fear of investors caused the stock market to actually lose pricing value, so our total return was still negative, not because we had a bad earnings and companies didn't make money better than they did the year before. They actually did great there, and we still collected a dividend. But it was because we were willing to pay. We were only willing to pay so much for those earnings, and that caused their total return to be negative. And again, 2019, you can kind of see how the opposite happened, right? In 2019, we had some earnings year over year, but what drove that top line total return X was we got more comfortable as investors, willing to be in the market, and we were willing to pay that higher multiple again for those earnings. So then let's skip 2020 and 2021, but look at 2023. It was also interesting. While companies continue to earn profits, we actually had a year-over-year decline in earnings. So earnings was negative as a function of its component for our total return for the year. But because the worst of the Fed was over, we were just coming off of 2022 and the massive rate changes that were happening and the bad inflation readings we were getting, the fear of, how many people were fearful of just deep recession on the brink? Investor optimism increased in 2023. And because of that, even though technically our earnings really didn't move much, it was slight negative, we had a positive year last year in the market, and it was mostly driven by our comfort level and ability to pay for those earnings that we see. So where does that leave us for 2024? Well, we believe this is a very important year for earnings. So right now, earnings expectation is somewhere between 8 to 12% for 2024, depending on the day and depending on who you ask. So if multiples stay the same, so if we're willing to pay the exact same for the beginning of the year for these earnings as at the end of the year, and we get roughly say 1.7-ish% in dividends, we could see anywhere from 10 to 13% returns in the S&P 500. The problem is investors don't tend to stay put. As we see in these gray bars across history, rarely is there a year where there's not some sort of swing or some sort of massive change in our willingness to pay, whether good or bad. So that's going to come back to sentiment and economic data and inflation and job market loosening and any surprises in earnings. LPL Research's year-end expectation is that we have a multiple of 19.5 times earnings. Oddly enough, that puts the stock market valuation roughly where it's at today. And so we expect them to potentially change their year-over-year outlook as far as the end of the year S&P 500 value. But what's going to drive earnings, the growth in the market from here is an upward revisions in earnings, and then a continued, positive sentiment about where we're going as an economy. I just saw I was on a morning call with LPL. They do a call for us advisors every day. One of the interesting facts that we probably won't put a lot of stock into, but it's interesting nonetheless, is anytime you have a year where January and February are positive, and looking at today's markets, I don't see a change in that we'll have two positive months in January and February. Historically, the average return for that whole year is around 19%. Again, this we're not signaling huge bullish signs because of that seasonal data. But what that means is when there's momentum early on in the year with the stock market, it takes a lot for that momentum to shift unless we see massive changes in the data in the economy or unexpected events that could warp our sentiment and our willingness to be in the market. Now, it's also good to be aware of the always present volatility, the ups and downs that ensue in every given year in the market. And we've shared this graph in the past. In fact, a lot of companies have this graph on their websites. I think it's a very telling graph, an important graph to see. But what it does is it shows the positive returns or negative returns. So look at the black bars. And then what the major intra-year declines were that, or what the largest intra-year decline in that year, calendar year, was. Meaning from whatever point in the top of the market to whatever point in the bottom of the market, what was the biggest drop intra-year before we ended the year, and it could have been a positive or negative year. But inside of that year, how far down did the market move in one kind of period? On average, the market tends to drop around 14% before it gives its final year-end return. If you just strip out the negative years and just look at the positive years, that average decline is slightly lower, so closer to maybe 10 to 12%. But this is a good reminder that upward moving markets will experience short-term bursts of volatility through the year. I mean, you can go in here and look at years where the markets, like last year, we had a 10% correction in the market, but we ended the year up 24% in the S&P 500. In 2012, we were down 10%, up 13. There's 2009, we were down 28% in the middle of the year, but up 23 by the end of the year. So the point is, if we do think that our economy and our markets are going to continue to go in the right direction, it doesn't mean that we don't expect volatility. We do expect volatility, and those volatile moments in the market can be opportunities, but also they can be good gut checks to say, stick with your long-term strategy, because this happens every year. All right, let's move on to the bond market. It's important to continue to understand the relationship between bonds, which is our safer part of our portfolios, and interest rates, and in the interest rate environment we see today. So where are risks in the bond market, and what would cause the bond market to perform well or not so well this year? And really, the yield curve is one of the major drivers, in my opinion, of what that return will look like. So if you watched any CNBC in 2022, one thing that was repeatedly discussed was the yield curve. In its basic form, the yield curve is the interest rates being received, or sometimes demanded, on the US Treasuries, so the US debt that they issue, that matures at different times. In a typical economic environment, or what we would say in a expanding economy, or in one that is not signaling recession, typically investors are willing to earn less interest by owning a shorter maturing treasury. And the longer that they hold the treasury and they're locked in, they want to see a higher rate. But when you see the short-term rates go above long-term rates, the yield curve is set to have inverted, and this has been historically a predictor of many recessions in the past. So the fear in 2022 of recession that we discussed previously, it wasn't unjustified that we would have one last year or even this year. But you look at historical signals like the yield curve. Another one that is still underwater is the leading economic indicator index. So they weren't unfounded, but we did see that inversion happen. But as it relates to bonds, the yield curve drives bond performance, and it's not the only thing that drives bond performance. So don't hear me wrong, but it is what I think is a very strong predictor of job performance if you knew which way the treasuries were going. Specifically, the 10-year treasury. It drives overall bond market index because it's basically our standard for then how we will price in, instead of a treasury, I'll buy a municipal, or instead of municipal, I'll buy a high quality corporate bond or a low quality corporate bond, etc. So when the 10-year treasury has dropped, we've seen significant increases in bond prices. And then vice versa, when the 10-year treasury rate spikes, we've seen a drastic drop in bond prices. So most notable was 2022, when the 10-year treasury, I think, started the year out at about 1.5%. So in January, you could buy a treasury backed by the US government who can print cash. Not saying we want them to, but they can. So consider it a safe investment for 10 years, and you get a 1.5% interest rate per year till it matured 10 years later. By the end of 2022, because of how rates changed, it was in the mid fours, meaning an investor who purchased a 10-year treasury in December would hold it for 10 years and not get 1.5%, but 4%. And the result was the bond market index and prices of bonds dropped drastically. And in general, the US aggregate bond index was down 13%, which is its worst performance in the history of the bond market. And many of you saw this, knew this. That's not why you logged in today to hear me talk about 2022. But it's important to know that that is what really drove the market, because again, and I think I said this in a previous webinar, if you were the person, the investor who owned that bond, that 10-year bond that paid 1.5%, and you decide you want to sell that bond on the open market today, and you go to the market to say, hey, would someone buy my bond? No investor is going to pay what you pay for that bond, because they can go buy a brand new bond at 10 years for 4%, or even a 9-year that matures in the same time yours is maturing at around in the 4% range. So for you to sell your bond, you have to lower your price to give them the same total return they would get by buying a new issue bond to that day. And so that's why we saw that drastic drop in bond prices. So in 2021, the bond market was slightly negative. Then 2022, the bond market was negative. And I would say that if it hadn't been for the Fed's announcement last November, that we could have seen a historic negative bond market for 3 consecutive years in a row. What changed? What made last year a positive return in the bond market? Well, if you look at the gray line, this was the Treasury yield curve at its peak in late October last year. At this point in time, the overall bond market was tracking around a slightly negative performance for the year. Then the Fed came in and talked about inflation easing, and they were set to begin rate cuts next year as early as March. And they basically telegraphed a future decision that they have not made yet, but that they will make. And like clockwork, the market responded. So you can see by the end of the year, which is the black line, the yield curve had dropped significantly on the long end of the curve. And what did that do to bonds? It made bond prices soar. The market was pricing roughly 4 to 6 rate cuts in 2024 at the end of last year. So when you see that shift from the gray line to the black line, that was indicative of a huge market rally in the bond prices. So then we got more data. Job market, strong. Stronger than expected. Inflation, missed expectations. All of a sudden, both the Fed and the market are backing off of their expectations. Since then, the yield curve has now come to a less steep level. So we're at, this was as of I think last week. And the bond market is now again showing a slight negative year-over-year return. The Treasury market and the pricing that happens in the Treasury market moves the bond market. Notice also that the short end of the curve didn't really move, because that short end of the curve is much more sensitive to the Fed funds rate, which has stayed the same. And the longer end is more reactive to economic growth expectations and inflation expectations and whatnot. So another issue we have is that we have more treasuries coming due. So this is another issue in the Treasury Department, and that will affect bonds. More treasuries are coming due that need to be reissued at higher rates. And more treasuries are being issued because of our massive budget deficit. So the challenge we see this year in the bond market is that the longer end of the curve may not decline at the level hoped. We may not see this massive drop in the yield curve, which would push bond prices up and have a great year. It will depend on the demand for treasuries of our own consumers, demand of our treasuries from other countries, from the Fed. We believe that the yield curve will really more just stay put and will stabilize this year. And that will allow bonds to still maybe have a positive return, but it's not going to be some massive recovery return that is making up for 2022. And it's important to know that as a bond investor, we think. All right, one slight concern we have is that in the bond market is that lower credit. So the lower credit high yielding bonds seem to have somewhat fully valued in and have a full value. So we're not really proponents of going and buying bonds that are lower in quality because they pay higher, because right now those are priced in pretty fully in value. So we feel much more convicted on staying on the safer side of the bond market and collecting those higher income rates that we're getting right now because of where rates are. All right, so our broker dealer LPL puts out every month what they call a GPS, their global portfolio strategy report, and it just shows where they favor, what they favor in the way of asset classes and sectors for the stock market, bond market, and then alternatives. So every time we have one of these, we try to always, kind of show what their current positioning is. Right now, in the stock market, LPL is much more positive on staying more domestic than going out into international markets. Now, it doesn't mean that international markets can't have positive performance or better performance than the US, but right now the bias is to be more weighted into the US side than international. They're also much more positive on large companies. What's driving the market right now and what drove the market in 2023 will continue to and has continued to drive the market for the first 2 months of the year, and in growth companies as well. So the trend is continuing. The companies that are pushing the market forward, in LPL's view, will continue to push the market forward. And then sectors like communication services, and then energy has been a most recent positive in their positioning. Still want to have value stocks. Still, again, a lot of people still want to include that global market, so still want to include some international exposure, just having it underweight. And then LPL's positioning on small companies and mid companies is slightly negative. They see the interest rates staying higher as a headwind to smaller companies. And we actually feel a little more neutral about that, and we have a better feeling for being overweight mid and small versus overweight international if we want to diversify. And then emerging markets, emerging markets are made up of a lot of countries that will have very different growth prospects, and because of that, and with some of the real geopolitical risk that we see out there and the economic issues going on, we and LPL are both negative emerging markets in our portfolios, and then they're also in consumer staples and real estate. Although I think real estate might change in the course of the next few months, depending on how the Fed changes rates. So that's where they're at in the stock market. On the bond side, if you're in bonds, which means that you're always managing this, how much do I have in stocks, how much do I have in bonds? Because of the price decay that we've seen in the bond market, we actually would look at the bond market versus the stock market and say the bond market's probably more undervalued than the stock market is. So if you're owning both, it might not be a bad idea to maintain a slightly higher overweight to your bond allocation than your stock allocation. But again, that's a moving number. Mortgage-backed securities, things that are, debt that's backed by assets or other things is important. Agencies they like as well. And they like short-term. So that if you're going to buy something other than Treasury, buy it on the short-term side because you're still getting paid pretty well while the Fed leaves rates up. On the neutral side, duration just means how long of a bond are you owning. So the general bond market, if you look at the index, has about a duration of about 5.5 years. They're pretty neutral that. We're currently slightly underweight that because of the thought that we felt like the overreaction in November of last year was too much, and that the supply demand of the Treasury market is not great. So We maintain a slight negative duration, but LPL is neutral. They like treasuries because they're safe and they pay well. They do like maintaining some diversification in the bond market. So keep your high yield bank loans and emerging market debt, but no overweights there. And then they're just negative if you're going to go on the long end of the curve and you're going to buy longer term bonds. You don't need to buy corporates necessarily because those longer term treasuries are also paying the same rate, hypothetically given the day, but really close rates, but with much less risk involved in credit. So that's where their bond positioning is currently. And then alternatives, and I won't spend a ton of time on this. We do look at alternatives in our models and how we manage. We stay more on the hedged equity side, so buying equities, but then buying insurance on those equities. We utilize that a lot in our management. But LPL is very positive on a lot of things: energy, managed futures, putting a strategy that has multiple strategies involved. The idea of alternatives is to create an uncorrelated return to bonds and stocks. For all of my investors who ask about gold, right now LPL is neutral in precious metals, not positive or negative, and then other metals and ag. So those are the positions of LPL. If you ever want to know in a part of the year what LPL's new positioning is, because these things could change, by the month, reach out to us. I'd be happy to share, where LPL's positioning is, and then explain kind of if we agree or if we feel different. All right, so finally, and just one slide, we'll wrap this up. Again, I think a few minutes over, probably on time, but we just want to talk about, policy. And right now, I mean, the one main concern is it being an election year. So this graph shows election years as it pertains to the 4 presidential cycle years. And it's historically been the second best year in the stock market. So if you think of the presidential cycle, you've got, year 1, 2, and 3, and 4. So 4-year cycles for presidents. So the second year is considered the midterm year. And then the 4th year is the presidential year where we vote. So if you look at returns, we're not much into the seasonal investing, but again, if you look at returns, the 4th year is historically been one of the better years, averaging around 9.5% return, and it has the second best probability of being positive. But again, seasonal stock market behavior is just not an adequate justification to predict our future returns. So just like the sell and may go away philosophy, it doesn't always pan out. We don't always expect volatility to pick up this year. We do think we'll see volatility this year for a lot of reasons, but we don't think it's just going to happen because of the presidential cycle. And we don't see it as a major catalyst for stock market direction. What's going to move the market this year, again, is we believe is earnings and the yield curve for stocks and bonds. That's going to be the largest factor to us. The economy second, and then maybe 3rd or 5th or 7th down there will be the enormous promises that each candidate's going to make that they're going to do when they get into the White House or stay into the White House. And so what we can say, and I don't have a slide for this, but I can share from past webinars, is the market does like, historically, seasonally, the market does like years when there's gridlock, or not one party is controlling the Oval Office, the Senate, and the House. So if we continue to see the gridlock or that accountability through the rest of this year and into next year, historically, it's also been a positive sign for the markets. So will the Fed successfully maneuver a soft landing? Will there be a landing? Will we come crashing down? Answering that question requires understanding all the different risks and opportunities that are present and that are here this year. And so the base case is still that it's a softish landing that's coming. We know this is not a common thing that the Fed does, is create a soft landing. They have done it in the past, and we do feel like the probability of success is higher in this cycle than it has been in a lot of the past cycles. So thanks again for listening or watching the presentation. If you'd like to know more about anything we've said or have questions after the presentation, please don't hesitate to call or email Brad or myself. We'd be happy to have discussions with you. Otherwise, we hope that this has been helpful, and we look forward to returning with our 2024 mid-year outlook later this year, hopefully more on time. And again, we appreciate your patience on this one. Thanks again. We hope you have a wonderful spring season. Please stay on the line for additional disclosure pages. Thank you.